Check, 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 check. All right, everybody. Hello again. Thank you very much for my YouTube family. Appreciate having you here. If you're here, you're probably looking at this risk management tutorial and training. It's really a lesson. There were a couple people asking about the risk management tool that I had created for myself, and I think Laura was one that was asking for if we could share it. And that tool, it doesn't make a lot of sense to share on its own. In fact, it's more beneficial to talk about risk management overall and have that be a supplement to what you need, how you need to think about risk management. So hopefully this is a short lesson here. I'm going to cover a few topics, and I'm going to direct you to what I used to study risk management as well, and what has made me into a profitable trader who is able to be more of a risk manager. So we're going to talk about all those kinds of things today. So take some notes, pause the video when you need to, and hopefully this will be a little short one. I will be going through a couple of concepts that you need to know so that you can understand how to use the spreadsheet. So listen up, because there's going to be some important points here. So let's get over to it. Actually, let's go here so we can see my face too. So today's topic, funded account risk management. We know that we have a lot of prop firms. We know that we have a lot of people that want to be funded. They want to go, and they have less capital. They want to use these companies' capital. And when you get to your performance accounts, you need to know how to not blow your funded account. And what that all comes down to is proper risk management. So what are we going to go through today? Well, we're going to go through a few first principles that are going to help you as a trader keep those accounts for longer and not feel like you're in a rush to get to profitability. I know it can be kind of tough sometimes, given that you've paid $140, $180, $200, $250, $300 for an account, and you want to make that back. But specifically, we'll be using the concepts within Apex Trader funding, which is typically futures and Forex futures only. This is not for Forex traders, but you can certainly trade Forex futures the same exact way too. So we're going to go through, what does risk management mean? We're going to talk about why it's important for us as traders. And then we're going to actually go through an example, and I'll go through a live example as to what it might look like to you and how to think about risk so that you're never going to blow your account, or you're actually going to be in a far less likely situation to blow your account. This does require patience, but we'll talk through that. So the first thing is first, we need to define this, and you need to know this deep inside your heart first before you start trading. What is risk management? So risk management is knowing before you even enter a trade how much money is in your account and how much you are willing to risk in any trade, so that you are always thinking about how to minimize your losses. If there's a manual intervention, if there's something that happens, that there's, you need to know what's happening on the economic calendar, in addition to where your individual trades stop loss will be, so that in the event that you are not on side, or that there's a brokerage spread hunt, that you know where you are what you're willing to risk to gain some form of reward in the future. Commonly, this is defined as either a dollar amount. It could also be defined as a percentage, or you're oftentimes going to see R:R, which stands for risk to reward ratio. So it's really important for you to understand what people mean when they say you have to have good risk management. I didn't understand this at all. No one could properly explain this to me. People were always just shilling R to R ratios. Fine, but that's bullshit if you don't know what the underlying foundational definition of how this is going to keep you in the game long enough to be profitable. One of my mentors, a guy goes by this name Plunger, he said that once you start thinking about yourself as less of a trader and more of a risk manager, that's when you'll start to see profitability. So let's get into why we care. And actually, first, this is where I learned a lot of my stuff. So you'll see down here, Inner Circle Trader, there's no secret that of who and what concepts I learned from. I give a lot of props to Michael Huddleston here. Month 2 in their 2016 content is where you're going to start to see a lot of that core mentorship. That whole 2016, like the whole playlist is a wealth of knowledge there. I actually go back to study concepts that maybe I'm rusty on at times, but that's where I went to learn. That's where I highly recommend you go, because they go very, very deep into, or he goes very, very deep into those concepts. So it's really important that you go spend the time and study that too, so that you can understand what I'm talking about here and have additional foundation, because Michael explains it quite clearly with other examples too. So why do we care as traders about this? Well, whether you're trading a live prop firm funded account, or if you've taken money out and you're trading your own live account on margin, they're both real live money, and any losses are gonna feel like you've lost real live money, because you have. So your psychology is gonna change a little bit whenever you have live money on the hook versus fake or demo account money. It's all the same price action, but something changes where you just feel like you feel a little more anxiety if you haven't had the time in market, if you haven't seen proof that your model works over time within demo or demo environments. If you don't have that and you got lucky and you got to a performance account, you're going to want to take a little bit of a step back and manage your risk. So if you haven't watched how to pass those funded accounts videos, there's another video that I made purely for that. And once you get to the performance accounts, you want to start sizing down to your risk parameters, and we'll go through that in a moment, in a couple slides. I'm actually going to pull up my tool and I'm going to walk you through how to use it, how to think about risk, how that translates directly to your charts, your money, your own thresholds. So really, proper risk management helps you define those parameters to keep you in the game long enough so that you survive those initial drawdown points, to the point where you pass there's usually a threshold where the prop firms stop trailing your stop loss. And then at that point you build a buffer, and then you can keep on building wealth over time. So those are reasons why that we as traders care about risk management. So we're going to talk through a couple of examples about what that is, why it works, and what we need to look for. So the third thing that we're looking at today is how you should think about framing your risk. So when you think about risk management, you need to immediately go to, hey, for every single trade that I put on, where is my stop loss? Where is my target? If you can get into the habit, and this is really important here, if you can get into the habit of never entering a trade, just a YOLO trade, I think it's going up, so I think it's going to keep going up, I'm feeling FOMO, I'm missing out on everything. No, don't do that. You want to resist the urge to do that. That's an impulsive move. Never enter a trade again if you don't know where your stop loss is going to be. Now that's really important there, okay? And we'll cover an example in the next slide, okay? You need to think about, hey, when you're trading these prop firms, we'll go through an example on Apex as well, but how large is your account really? Do you really have a 50K account? I think that these prop firms are they don't mean to be, but they probably do. Let's be honest, they mean to be, when you say you have a 50K account or 150K account, whatever it is, right? You don't actually have control over all that $150,000. It's actually whatever's trailing, and we'll go through an example of what that looks like. So we'll take a look at what that looks like within Apex Trader Funding, and we'll also take a look at the risk management tool that everyone's been waiting for, and we'll walk you through that. So let's take a look at Apex first. So this is the Apex site as well. You know, in my prior videos, you know that I focus on the 50K account. This has starting capital of 50,000. This would mimic margin required to trade these, and a trailing threshold of 2,500. So that is something that we're most commonly going to refer to in this example for Apex. Okay, so let's take a look at this dollar amount here. So remember, I've gone through this example. If you've seen the other video, you've gone through this example too, but it's important to come back to this so that anyone who hasn't watched it can really ingrain how these prop firms work. So when you're in evaluation, or even when you're in a prop firm funded account, what these trailing stop losses mean, when you trailing stop loss is minus 2,500 for a 50K account, that means that, hey, any unrealized gain, your trailing stop loss will trail up with that unrealized gain. So if you start a 50K account, let's say you gained $500, you closed out of your trade, boom, you're at $50,000 and $500. That means your trailing stop loss has trailed up from what was initially 50K minus 2,500 or 47,500. It's now trailed up $500 because that's where your unrealized gain has been, $48,000. Let's say the next day you do really well, you see a great trade, and you actually let the trade go up to positive 1,500 from that 50,500 position. But let's say you didn't close it and you thought it was going to go up, you let it retrace, and you moved your stop up to get stopped at $500. Well, your stop loss and your ending amount on your account's $51,000. But look closely. Your stop loss, trailing stop loss, has actually gone up $1,500 because that's what your unrealized account has raised. So now you will get your account blown at 48,000 plus 1,500, so $49,500. So since your account technically reached a value of $52,000 at some point. And so you can see in your next trade, let's say you lost $1,000. You're now down from, back down to $50,000, and you're down to $50,000, and your trailing stop loss is at $49,500. So that means that in $500 more dollars, you're gonna blow your account, right? So that's where proper risk management and framing it risk is really important. That $50,000 account, you don't actually have $50,000. You have whatever you've trailed up on your account. Now, for these funded accounts, once you get to a performance account, and once you get your performance account to a value of 50, back up to I think above a value of $50,100, the beauty of these performance accounts are that they stop trailing. You can actually start to build true capital there. You can treat 50,100 as like the absolute low, and that's the absolute low in which that your trailing stop loss will stop being trailed. That means you would have gotten your account to $52,000 and $600. So 50,000 plus 2,500 of a trailing stop loss plus 100. At that point, it stops trailing for funded accounts, for performance accounts, and you're done. So that is one good thing if you can stick it out that long. So I think that is kind of key, and risk management will help you do so. So let's now get into the tool that helps you frame what those numbers look like. And this is really important, so make sure you're taking some notes and taking notes on how to use this. So this is the tool that I created. You can use this to mimic any any one of these futures contracts, provided that you know what the tick per 25 cent or per 10 cent value is, you can define that here for micro NASDAQ. A NASDAQ contract, every single tick or 25 cents it moves, it's about $5. So for a micro NASDAQ, it's 10 times less than that. So 50 cents per move per quarter tick. Now, how many ticks are in one point or one handle? There's 4 of them. So 1 point is equal to 4 ticks. So what I started with is, hey, what is my max allowable loss? And what would that account size be for me to have that number of a max loss be 2% or 1% of my account? The reason I started here is, remember, we are working with those 50K accounts which have a trailing threshold of $2,500. This means that if I'm only allowed to lose $25, I wanted to calculate how many handles does that translate to? How many contracts can I use? And what does that minimum threshold look like for me to be only risking 1% or 2% maximum? I would recommend you risk 1% because you're going to be staying in the trades in much longer than you would if you were to risk 2% or more. So I have given an arbitrary threshold of 12.5 points, total points. So if you take 12, how many ticks or 25-cent increments is that? 12.5 times 4. That's a 50 tick stop loss. You can use 10 points if you don't want to make your stop loss so big, and you can also change all these values to calculate depending on what is there. So based on one contract, this is why I used this. This is why I use this math, though, is I use the max stop loss that I would like, and then I use the amount of contracts that I would stop at. You could change your max stop loss down to $20 or $15, but at that point you're also lowering the amount of range you have for the amount of give you have in any given market to move against you. So if you lower it on something like NASDAQ, I would not go lower than 10 handles because it's very common for price to spike up around that range. So you'll see that I have different max loss values in column A. Those are values that I have calculated in order to give me a proper view of when I can then start to add another contract. And this gives me an idea. Column C gives me an idea of when I can safely add, let's say if I have 1%, if I have $5,000 in my account now, net $5,000, I can choose to risk 1%, and that would equal $50 here. And I could actually use 2 contracts and a whole stop loss of 12.5 points in order to reach that $50 loss if I were to get stopped out within my parameters. So I take a look at 12.5 handles of loss any trade that I go in. Now, at my discretion, I can change it and move it slightly, but in the beginning as a new trader, you're going to want to practice with how big of a stop loss that you're willing to take and what percentage of your account are you risking because of that. So on a $2,500 trailing stop loss, that's why I only risk 1%. So 1% of that's $25, right? So that's the reason why you see all these green highlighted 12.5 handles. I go through and calculate for number of contracts for micro NASDAQ. I go and calculate for how many contracts, when can I start to use that stop loss for, let's say I get up to a point where my account is, I don't know, I want to see when I can start using five micro contracts. Well, what does this say? this says that I need my dollar amount to be 12,500 in order to risk 5 contracts of micro NASDAQ, and that dollar loss would be $125. So as you can see, a lot of this is framed off of what is my max loss I am willing to risk if I'm risking 1% of my actual account. Okay. So this is drawn out over time, and I'm not going to go deep into these details. You can kind of see the math, look at it yourself. But where you want to make changes would be what your max stop loss should be. This file is going to naturally automatically calculate what your maximum account size should be in order to handle that level of max loss for any 1% loss or 2% loss. Yes, you can risk more. In fact, if you're a seasoned trader, I would recommend that you pass the evaluations quickly, because you know what setups to look for. If you're new though, you need to focus on defining what is your model, what are you looking for, what in the market is telling you that, hey, this is going to draw towards this next area of liquidity. If you don't know what I'm talking about with liquidity, that channel from before, Michael Hudson, Inner Circle Trader, is one that I would study many, many hours. I've put thousands of hours into that and studying and taking notes. So one thing I want to put you on though is further down in column 70 or row 72. I actually also calculate, hey, for what number of contracts, if I were to target a 10 handle move or 20 handle move or 30 or 40 handle move, what would the dollar amount be that I would end up returning? So this is where you start to get into those risk to reward calculations. So if I am risking one contract up here, I risk one contract of a max loss, and I can use one contract and use 12.5 handles in order to hit that $25 of loss for one micro contract. But on the flip side, when we're thinking about the rewards, if I were to sell at 20 handles, that gives me $40 profit. That if I were to sell at 30 handles, that would give me $60 of profit. Or 40 total handles or points would give me $80 of profit. This is where you can start to frame your risk to reward, because I'm risking 25, right? So if I'm looking for a R to R ratio of 1 to 3, I'm risking 1 to gain 3. So I'm risking one block of $25 to gain 3, which would be 75. So I'm looking for those types of trades. When I'm entering a trade, does it give me a 3-to-1 ratio? You can go for lower ratios too. You can go for 1-to-1 as well. Who cares if you gain $20? You know, start there. Start building $20, a day, and pretty soon every week, if you get $100 a week, that's $400 by the end of the month. That's amazing. So those two things are very crucial on this. Now you'll notice that this is for micro NASDAQ. So you'll see that my calculations go down to about 110 contracts, because on the 50K account, you can trade either 10 full NASDAQ contracts or 100 micro contracts. So for that reason, I kind of stopped doing calculations at a very, very keen, equal level. When you get past that point in time, you're probably seasoned trader. You could trade 10. It's the equivalent of trading 10 contracts of NASDAQ. That's a lot of contracts. It's going to take some time to get there. But once you get to this point in time, though, note the levels that we're at here, right? So when you get to that point, you should have about $250,000 in your account. Like, that's the size that you need in order to risk 10 or 100 micro contracts and still be able to only risk 1%, which is minus $2,500. But what about the reward? So in these increments, I'm thinking about, okay, well, how do I make the next $12,500, right? How do I add the next $12,500? And how long might that take for me to gain that? So what do? I use this chart. I go to the 10 contracts I've been using. I have a $250,000 open right now. I can risk a loss of 1% of minus $2,500. What can I gain? So if I'm gaining, if I look at 10 handles, 20, 30, 40 handles, I get $2,000, $4,000, $6,000, $8,000. I can actually achieve that $12,500 that would get me to this next level a lot quicker, right? And then I can shift to 105 contracts, risk 1%, would be $2,750. Same thing for 110 contracts. Now, at that point, you'd have to go get another performance account. You'd have to go pass one of the 150Ks that gives you access to a few more contracts. But as you can see, you can do pretty dang good with just 10 contracts at that point. It's going to take a while for you to get there. Don't try to rush it. But this is how you use this resource. I'm actually going to set up I'm going to set up probably an email capture, because I want to make sure that I can connect with you as well. And I want you to be able to connect with me too. So I'll probably set up a quick little landing page for you to enter your email, and then I'll send you the physical file, and then you can then start to fiddle with the numbers based on what your risk parameters are. I want you to do some homework and look at the charts, see for whatever instrument you're trading, look at the charts and see what you're willing to risk. And speaking of looking at charts, let's see this one micro in action. So remember, I'm looking at a stop loss of 12.5 handles for a potential 1 to 3 risk to reward ratio of $75, right? So let's take a look at the charts. If you remember, my day 31 live practice action for Thursday, if you hadn't watched that, at the 6:10 mark and 37 seconds, I'm going to play this right now. And I actually open up Chart Trader here, and I marked where I want to look for, right down here. I've been marking that. So you see that I just entered a trade. It's up about $20, $23, $24. You can see where it's at right there. I noticed that we went below this short-term low, and we are holding there. And so we had immediately rebalanced off of this fair value gap. And now my entry all day, I tried to enter on a upswing, but it and this is a rise back up to a fair value gap, or actually it's up to a bearish order block right here when I saw that immediate rebalance. So I tried to enter here, but it actually entered a little bit lower. So you can kind of see how this trade starts to pan out. I took this live, so you can go back to this one and play it again to see and look at what's in the market. All my levels are marked there. So what you see here, eventually I think I changed the numbers to points, because from a good risk manager's perspective, the dollar value doesn't really matter. It's whether or not you entered the trade well, your stop loss is at a reasonable point, and that you can now cover what you need to with a good stop loss and a good risk to reward target. So you can see where I entered, my stop loss was originally above this black candle. You can kind of see I've moved it down to a little bit below mean threshold of this bearish order block. I actually should have left it up here. So that is a poor. I think I moved it back up there at some point though. Maybe not, but can't remember on this one. But we do see that price begins to retrade back up, and I don't anticipate it, because I've seen it fall and immediately rebalance from this fair value gap. I don't expect it to do anything more than hitting the bottom of this bearish order block and immediately rejecting, which it ends up doing there too. You can't see it because the red X like stop out is there, but this is an example of and we're going to go into the charts as well to run through this example and how you can also see how its risk to reward is framed. So so this trade continues forward for a little bit, and here's where I change on Ninja. You can change from dollars to points. I changed that now, so you can see we're at 14, about 14, 15 points of profit here. And eventually you're going to start to see some pretty quick action on that day. Let me see, that was at, see, this is at about 2 o'clock in the afternoon. So I took a fair value, you can see the gray there. I took a ICT silver bullet trade. And so zooming in a little bit more for you, hopefully you can see, hopefully I leave it like a little bit open there. So we're in the ICT 10 o'clock or 2 o'clock to 3 o'clock silver bullet hour. We see that we've continued to have lower lows and lower highs, lower lows. So I'm seeing market wants to go down. So now we're at 25, 26 handles of profit there. Am I closing out? No. I have a lower time frame objective that I want to hit, right? So there's a lower time frame objective there, and I want to be able to tackle that. And we'll go into the charts to show you what that was in the past, but I want to make sure that you can see what that looks like as well once we pull this back up. So let's give it a moment there. We kind of see that it continues, sees a little bit of a drive upwards. Then this was on this account, yeah. And we will actually show that where we exited, there's actually a previous low. So a sell side liquidity is where my limit order is currently being placed. In fact, that particular sell side liquidity is also at a point where there's a daily, you can kind of see it there, this daily premium SIBI high. So with that kind of confluence, I'm looking for it to take the full 40 points right there. Can it go lower? Absolutely. But because we have this sell side liquidity there, kind of relative equal lows, I wanted to see it push to here and take that out. And so, of course, as you can see, as this plays out, we end up nabbing about 40 handles, and that profit is 80. So let me pause there. Okay. So we see that that profit's 80 there. Let's go back to that risk calculator. Remember, one contract, 40 handles, $80. What does that happen? One contract, 40 handles, $80. Let's look at that trade a little bit closer, okay? Now this is really important here, so pay attention. I entered around here. I was trying to enter market sell when it came back up into this bearish order block, because I kept on seeing lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, as it was drawing to a higher time frame draw on liquidity. So we have this area of risk here. You can kind of see that this is the 12.5 handle that I was looking at. 12.5 handles gets me to above this previous lower high. And because the market was still heading back down to a key area of liquidity, I was thinking that now, hey, I see this on the lower time frame. I can take it, see how it will apply. Now, I don't have these boxes on, but it's important for you when you're back testing to take a look and see if your move would have produced something like this. So that 12.5 handles, that's one risk. And I want to see if I can have 1, 2, 3 reward. It does, right? So my target was here, and this daily SIBI high, right? And what happens? Well, it gives me about 3.5. Let me pull this over here so you can see that marker there. So it gives me about 3.5 R if I were to have entered right here. Now I didn't, so I got just about $80 off of that, which was a 40-point move. But this is what you kind of are looking at, right? When you see one risk to 1, 2, 3 reward, when you combine that with the numbers and the structure that I give you on that Excel sheet, that gives you the math to really understand, hey, what am I truly allowed to risk and what is my expected reward? In the beginning, you can just go for 1-to-1. That's totally fine. $20 adds up, $40 adds up, you know? There's always going to be a trade here at 2 o'clock to 3 o'clock. There's always going to be a fair value gap that you can take. This day was just a really good example of it. And yeah, that's really it. I mean, that's as simple as I can make this. So I'm gonna set up. I'll put the email. You know what? I'll put the link in the description below, where you can go and download this Excel sheet. I will want to connect with you, so I'll probably request an email at least, and then eventually when if I end up doing something with that, I hope to be able to stay connected with you in that way. So hopefully this has been helpful in walking through the risk calculator that I have created. And, you know, I look forward to seeing all of your, whatever you trade. It doesn't matter what you trade. In terms of futures, you know, you can use this for other things too, but you have to just make sure that you have the right value per tick, and it's easier to apply to futures, because that's what I trade, and that's what hopefully you will trade too. So with that, I think that's it. We went through a lot. What does risk management mean? Why is it important for traders? How to think about risk to not blow your funded accounts. And so this should give you a primer on how to deal with funded account risk management. So with that, I'm going to thank you for listening, and I appreciate everyone who's subbed. I think we're up to like 189 now, which is insane. I'm so blessed and fortunate to have a community like you. I appreciate all the criticism, constructive criticism, suggestions to make this better. I'll try to work on them one by one. It's really tough to do a full-time job and apply all of these ideas at one time, but they're fantastic ideas, and I promise you I've written all of them down, and I will work through all of them at some point, okay? So yeah, I think with that, we'll stop there, and we will, I'm gonna go look at, and I think today I've got a potluck party to go to, so hopefully you're enjoying your weekend as well. I will put a post on YouTube to release this one. If you have any questions, just drop them down in the comment. I will try to premiere this as well when I can. If I can't, I might just release it too, so that you have access to it. So with that, have a great day, and go back and study, pause the video, play it, pause it, listen to the math, really focus on that math, and then apply it to that Excel sheet so you can study whatever tool you use, and you're going to have a much better sense of being a risk manager instead of a trader. And once you fully understand that and take that to heart, you will become a much better trader. So with that, have a great evening or day, and we'll catch up soon. See ya. Oh, And if there's any improvements that you want to suggest to me, like just drop them down in the comments and I'll look at that too. All right. Have a great one. Talk soon.